गुरुर्ब्रह्मा गुरुर्विष्णू गुरुर्देवो महेश्वरः गुरुः साक्षात् परब्रह्म तस्मै श्रीगुरवे नमः। विघ्नेशानमुनी गुरुसस्मरुनी लक्ष्मीस आवाहिले आम्ही गुंतवणूकशास्त्र शिकण्या हे सत्र आरंभिले। केव्हा स्थावर आणि जंगम कधी कोठे किती गुंतवू चर्चा मंथन तज्ञ बोध मिळता हे प्रश्नही सोडवू। ठेवी भाग सुवर्ण पोस्ट अथवा रोखे तसे फंडते वृद्धी भांडवली मिळो कर नको पर्याय हो कोणते। कोठे उत्तम रोखता सुगमता लाभांश वा व्याजही कोठे गुंतविणे सुरक्षित असे नोंदीस कैसी वही। सन्मार्गे धनसंपदा मिळविणे अत्यंत आवश्यक पैसा ध्येय नसे म्हणून जपणे जाणीव सामाजिक। ज्ञानाचा उपयोग गुंतवणुकी साठी सदा होऊ दे हे सारे समजावया सुमती दे आम्हास तू शारदे।
Good morning, respected members of PV Bhagwat Investment Guidance Cell. It is a pleasure to welcome you to this important session on building resilient portfolios organized by PL Wealth, part of renowned Prabhudas Liladhar Private Limited. Today's financial markets offer both opportunities and challenges. Building resilience in our portfolio has become more important than ever, especially with recent market correction since September 2024 and heightened valuations keeping us completely concerned. It is essential to balance enthusiasm and caution, ensuring that investment decisions are grounded in sound fundamentals. Thoughtful asset allocation and sound fundamentals are key to in navigating such an environment. Now more than ever, reliable guidance is essential. We are fortunate to have Mr. Rajkumar Subramaniam from PL Wealth with us, sharing his expertise on constructing portfolios that can weather volatility and support long-term growth. Allow me to introduce Mr. Subramaniam, who brings over 20 years of experience in banking and wealth management with deep knowledge in investment products and strategic client relationship. He has held senior roles at leading institutions including Axis Bank, PNB Paribas Wealth Management, ICICI Bank and Standard Chartered, to name a few, and is currently enhancing PL Wealth's product and family office offerings. We are grateful to PL Wealth and Prabhudas Liladhar for supporting this session for Lokmanya Seva Sangha Parle. Please join me in welcoming Mr. Rajkumar Subramaniam. Before he begins, I invite Sujit to hand over a small memento. Yes. I can't. Oh, I'm so sorry. Yeah. I'll request our chairman, Mr. Vinay Maskar. I'm so sorry, sir. I didn't see you. So over to you, Mr.
Thank you. Thank you so much. Of PL Wealth, I would like to thank all of you who are taking time out in the morning to join us. Not able to hear me?
Hold it in your hand, or if that is okay with you.
I can hold it in my hand like that.
Yeah, I think it's quite long. You can pull it as long.
Yeah, I think. Is it on? I don't think it's. Hello. Yeah, now it's on. So I can try and keep it here. I hope I'm audible now. Lesser. So let me keep this. Okay. In my 20 years of experience, I've seen different kinds of clients. People who start off as SIP investors and then over a period of time obviously they've accumulated wealth, and then there are people who traditionally have had business wealth or family wealth, and their outlook or their requirements are more in terms of preserving that rather than growing it, but preserving that. A lot of our clients have assets which they say we want to now give it away to the next generation, and to that extent over the next 3, 5, 7 years we want to ensure that it is growing, but it is not into any risky asset. So there are various requirements which normally comes our way, and one common theme that at least I have noticed in my 20-year career of being a wealth manager is clients are always influenced by what is happening currently. So if today one particular asset class is doing very well, a significant allocation ultimately goes into that asset class. So if equity is being doing very well, a lot of money goes to equity, and then the portfolio completely gets skewed towards equity as a category. Similarly, gold has done very well over the last few years, and you will now see a lot of portfolios having gold. Silver is the new buzzword. A lot of investors have now started talking about silver, and we have seen how volatile silver has been. And silver has traditionally been a very volatile commodity, but again there are periods in time when silver has done phenomenally well. But how do you build a portfolio around all of these? Debt is again one more asset class which unfortunately has been taxed significantly. I mean, there is no tax respite for any debt investor, whether it was fixed deposit earlier, and now mutual funds have also been categorized, and it has always been that 6, 7, 8% kind of return that you traditionally make in debt. But it is also very critical, because you can't create a portfolio without having debt as one of the asset classes. So what I've tried to do is put together all of our experiences into a few slides, and let me run this through. Please feel to ask questions, interrupt me in the middle. So what we have seen is you can't create a portfolio which is immune to volatility. So if our premise of starting to create a portfolio is that it will be immune to volatility, then we are starting on the wrong premise. The premise has to be that it will be prone to volatility, but how quickly can it bounce back, or how resilient can that portfolio be, is very critical. So if we start with the premise that I will create a rock solid portfolio which no matter what happens, it will only go up and cannot go down, it's unfortunately the wrong premise. And portfolios, it should be stable with a stable return. So how are you starting the portfolio creation journey is very, very critical as to where you end up. A lot of times we start with only one asset allocation, because that's probably is the flavor of the season or the flavor of something, and 100% allocation goes into that one single asset. Over a period of time, when the asset does very well, we get very excited and we keep adding only into that asset, thereby increasing the risk substantially. And then as it happens with every asset, it goes through its own downturns, and at that point of time we are hopeful that things will come back to normal, and we keep doing a lot of averaging. If it goes down 5-10%, we add more. It goes down 20%, we add more. But what we don't do is try and create diversification, so that irrespective of if one asset is underperforming, do I have other assets in my portfolio which are stable, and my overall portfolio return is delivering what is my expectation. So if my expectation was 12%, as long as the portfolio is overall delivering at something close to that number, I should be relatively happy. If it is then generating something significantly higher than that, either I am doing a fabulous job or one of the asset classes is doing a phenomenal return. And if it is doing the other way around, substantially poorer than what my expectation is, either I am doing a very poor job of allocating asset or one of the asset classes doing extremely poorly, which is dragging down the overall return. And you will see this happening because of geopolitical reasons, because of economic reasons, because of change in policy stance. Many of you would have seen how when capital gain structures get changed in budgets, suddenly the entire over the next 3-4 months a lot of reallocation happens, a lot of volatility starts. When GST was introduced or GST 2.0 was introduced, or when the Ukraine issue started, or the Middle Eastern issues started, a lot of volatility creeps in. One asset class does better than the other. Do we react to it? Should we react to it? Is also a very important question. So I just covered this. So it's important that whenever we design our portfolios, it should be across multiple asset classes. It should be to segments which have stronger balance sheets, which have stronger underlying fundamentals, and which needs to be constantly rebalanced. That, I feel, in my experience, is something that a lot of investors miss out, rebalancing their portfolios at regular intervals. We do make allocations, but some of the asset classes sometimes run up significantly, more than what we expect. But at that point of time, do we do a reallocation? And do we have a 6-monthly period or a 1-yearly period at which we go back and reassess the allocations across asset classes? And that is very critical. We set up regular cadences with our clients, at least a 3 months, 6 months, 1 year, depending upon what the client expects. And we run through the entire allocation and say, okay, now going forward, our view is ABC, and given that this particular asset class, for example, if it is gold, has run up significantly, my view may be continuing to be bullish, but do I reallocate it to some other asset class a little bit? If our view is yes, then we do that. If equities have done phenomenally well, then reallocate it and come back to the allocation that is what you fixed at the beginning. So if it was 60% equity and 20% to debt and 20% to gold, if equities have done phenomenally well, your allocation becomes 70% to equity. The other asset classes come down. We need to rebalance it and bring equity back to 60% at a regular interval. And when we do this, if equity does correct in the future, the impact on your portfolios to that extent will be reduced. So again, this is something a lot of you would have come across, why equities or why debt, why gold, why silver. So silver and gold is always a hedge and an inflation protection. A lot of investors have now started investing in REITs also. They are listed instruments. You can get regular returns on that. Plus there is capital appreciation. So anyone who's invested in REITs over the last 4-5 years since the embassy listed the first REIT, and today we have 5 listed REITs.
And they're doing well with dividends as well.
Yeah, regular. So you get regular dividends and you get capital appreciation. So and it is very similar to you personally investing in a commercial real estate. A lot of us have commercial real estate assets, and you will realize that you have an escalation clause in this. At every year or every 3 years, there is an escalation which happens. It could be 5%, 10%, 15% escalation in rent. That basically covers the inflation, impact. Plus, there is a property appreciation of that asset. So between the property appreciation plus the dividend, you get a fairly regular return which is also a hedge against inflation. So can we include that in our overall debt allocation?
Can the adverse thing in the real estate affect your investment in REITs?
It can.
But over the long run, will it have an effect?
Usually no. Usually no. Two reasons. If it is residential, yes, because it's for consumption. So you as an investor have a choice. Do I buy in location A or B? If location A is very expensive, location B is 2 kilometers away, I don't mind traveling that extra 2 kilometer, but I get probably a 15% reduction in price. So I don't mind going a little further away. But if you're a business, then you would want the most important locations. You want to be near a metro, you want to be near a business district. If you are someone like a stock exchange or someone like a wealth management entity or a bank, you would want to be in a place where there are a lot of businesses. So your options to move around is limited. So you end up coming to some of those locations and renting those places. So what happens is there is a time correction which happens. Prices probably may not move up for some time. It probably stays stagnant. But if there is no availability of property, then if you want to rent something, you'll have to pay a higher premium. So you tend to see price corrections, but you continue to see appreciations. The reason why you see continued appreciation is because there is rent escalation clauses. Every year a 5% kind of escalation is continuously happening.
And land cost is very limited.
Correct.
So
Exactly. So land value continues to increase, but if, for example, if it is, my office is in One World Center, so it's a ready office. You can't replicate another office anywhere nearby because there is no other space available, and it will be fully leased. Now, if I continue to stay there for the next 5 years, 7 years, 10 years, I'm paying 5% extra every year as an escalation, irrespective of what is happening to the property value. Unless tomorrow another location comes in, which probably is easier to access, has better facility in and around, and I see an ecosystem developing, maybe I'll move from here to this, which is what happened with Nariman Point, right? Over a period of time, Nariman Point got replaced by Lower Parel, then Lower Parel got replaced by BKC, and then it went to Andheri. So today you have so many pockets. Now each of these pockets are full. So REITs are another very interesting opportunity to de-risk your portfolio to some extent. But REITs are not risk-free per se. So you will, as you very rightly pointed out, you could have periods when property values are not moving up or or stagnant. You may see the capital appreciation part not happening, so only the dividends are coming in. There could be scenarios when the interest rates go up significantly and REITs borrow, so they leverage to buy properties. So when they leverage and buy a property, just like how mortgage loans are, if the mortgage rates go up, it impacts your budget. Similarly, interest rates go up, it impacts the overall efficiency of the REIT. So to that extent, dividends come down. So it's not immune, but to a large extent, we have seen even globally, it has had a fairly steady impact on portfolios. Income arbitrage is another very interesting category which is now coming up. In the last probably 7-8 months itself, the asset has significantly exploded in terms of AUMs, from something like 8,000-10,000 crores in January this year. It's now become almost like 50,000 crores, and more investments are coming. But when you deconstruct that, it is nothing but an arbitrage fund and a debt fund, right? Now, all of you would have anyway allocated to an arbitrage fund for a shorter term allocation. All of you would have invested in debt funds in some way or the other, whether it is a banking PSU fund or a dynamic bond fund or any of those categories. Many of you would have done. Now, individually, when you look at it, an arbitrage fund will be taxed like an equity, whereas a normal debt fund is getting taxed at a marginal rate. But when you put that into a fund of fund structure and then you invest in that fund of fund, suddenly you go into a equity kind of taxation, right? And from a return perspective, probably it's not too different from most of the other debt funds. But what you benefit is the tax arbitrage. So sometimes when you are allocating, a little bit of analysis in terms of the taxation and putting it in the right bucket also really helps. So this is something probably many of you would have seen, you know, how different asset classes would have performed across, and it's not by choice, but it's graded in terms of the performance return. So silver comes on top. So if you look at silver, this financial year, silver has given you something like 73%. But when you look at over the last so many quarters, 2024 silver was about 17%, 2023 it was about 7%, 21 it gave a negative return. So there are years when it will do phenomenally. 2018 hardly any performance, 2017 a negative 3% kind of return. So if I was a silver allocator and I had allocated to silver only in one bucket and say 100% to silver, this year probably I would be laughing away to glory, and probably I am the best wealth manager perhaps, but you know, in other years probably I would have not done as well. Same with gold. I mean, but gold has done consistently well over the last 3-4 years. But when you look at gold's performance, gold has always performed in waves. You know, there are 6, 7, 8 years of period when gold does well, and then there is a big lull. You know, it either slowly erodes down or continues to stagnate over a period of time. But when you look at a 20-year allocation to gold, you'll be surprised to know that in INR terms, gold is given anywhere close to 13.5% kind of compounded annual growth rate. And in that period of time, in that 20 years of period of time, there are periods when gold has significantly underperformed, and there are periods when gold has significantly outperformed. But if you were a longer term allocator to gold, you would have made a 13% kind of CAGR. Very interestingly, one of the strategies that we are seeing now with investors is a part of their debt allocation is now moving to gold. The reason being, whether you are a retired person or you are generally allocating to debt, you don't need 100% of that debt at one go. So you bucketing yourself, you keep part of it for liquidity, you keep part of it for income, you keep part of it as a longer term allocation, which is compounding and probably not giving you any return at this point, but you are doing it with a specific goal, maybe for children's education, maybe for repayment of a loan or for somebody's marriage, etc. So you may not want to touch that part of debt allocation, but you want it to be safe, you don't want it to be volatile. We are seeing a trend where a lot of investors come to us and say, can we get a better opportunity to allocate this? And we say, why not? You know, look at gold as an allocation. Say if you are allocating 50% to debt, can you not take out 20% of that and put it into gold? In terms of your overall portfolio, of 20% of 50 is 10% of the whole portfolio. But that 10% over a longer period of time is actually providing you a better compounding than debt itself. Debt may be giving you something like 7.5-8%, best case scenario, relatively safer debt. I'm not going down the credit curve and going for a AA minus or something like that. But I'm saying relatively safer debt will give you something like anywhere between 7-8%. Gold has given you better. But can you put 100%? No, because it's not income generating. You know, it's only a compounding factor. But you can actually allocate a small portion of that, of your debt into gold, and allow it to compound over a period of time. And
sir, in earlier slide, you had stated about dry powder concept, which is a liquidity related one. Can you just highlight on that? How much should be out of the total available funds should be always kept in that kind of 3%, 5%, whatever, means what generally people should follow. And once you have invested and once you have used that, again there has to be something which is available for you. Is that concept I felt from your earlier slide? Can you just elaborate on that?
you're absolutely right, and it will again depend upon the kind of investor that you are. So if you are a very aggressive investor and you allocate a larger portion of your assets into equities, we would say anywhere around 10% of the overall allocation should be in a liquid kind of assets, because there could be scenarios where markets may correct a 5, 7, 10%, and at that point of time you may want to at that point of time you may want to benefit out of that correction and allocate a larger corpus, and that is the time you will draw upon. Similarly, when do you replenish? When you, as I said, you need to constantly rebalance your portfolio. So when you've seen that if your expectation from equities was about 15%, let's give a number, but equities have done very good in that period of time and generated 50, 60% or 30% return, then you should start creating a buffer into your dry powder. You should keep adding, because sooner or later you will get an opportunity to reallocate. There would be some of those stocks, some of those funds, etc., which have significantly outperformed. Probably it may take much longer to now it will be a pause and then it will recover. Can you not take it out? For example, we have seen trends where small cap funds have done very, very well. Probably last 1 year or 1.5 years, the entire equity pack has not really done so well, but you have seen patches where the small cap have done significantly well. Have I done a reallocation at that point of time? Have I taken out some money? And it's not necessary that it has to be always 10%. It could be greater than that also, depending upon the scenario. But it is very critical, because opportunities for someone who is an active investor, a lot of opportunities keep coming in, whether it is at a stock level, whether it is at an asset class level. For example, if I am a very active investor and I was an allocator to silver, when silver did so phenomenally well over a period of time, there was a period in the beginning of October when silver ETFs were trading almost 15-16% above the intrinsic value. So they were all trading at a premium. If I was a smarter investor, I would say, okay, I've made a lot of money, I made almost 70% return. Can I now book profits, let that money sit into something which is more safer, or park it in a arbitrage, wait for my time and come back? And which is what happened. From something like 180 or 1,80,000 levels in the MCX, silver came down to almost like 1,40,000, 1,45,000. So it's a good 25% kind of correction. Of course, it's going up now, but it's volatile. So I might reduce my allocation by 20, 30, 40%. Go and sit there and wait and then come back. But again, the decision to do that you will also have to look at taxation. Today, if it is a short term, it is 30%, right? But if it is a long term, it is 12.5%. So if you have held for more than 1 year, it's a simple decision, because your tax outgo is only 12.5%, whereas the drawdown can be 25-30%. So you are actually still protecting a larger portion of your gain. So you can exit and park it there. But if you are a shorter term investor, 6, 7, 8 months is what is elapsed, doing that doesn't help, because you sell and you book your 30%, you have to pay tax, and then you go into something. The market corrects by 30% and you're coming back at that same level. So what you lost out in terms of market is what you've paid as tax. So you've not saved anything. So tax also is a very interesting, joker in the pack at this point of time. We need to be very, very mindful of the kind of impact it can have. So basically what this slide tries to tell is that across, there are phases when certain asset classes do very well. For example, equities have done only 7% this year, and it's October and November, almost the entire year is gone, and this is calendar year. So in about 11.5 months, it's about 7% kind of return. Previous year also it was about 16 odd percent, but at the same time, other assets like the global equities, whether it is China, whether it is US, have significantly outperformed India. somewhere we need to also be cognizant of the fact that can part of our allocation go offshore? Can it be invested in some of the offshore funds? Why? Because when global liquidity gets reallocated, and today which is what is happening, when liquidity is getting reallocated from US, part of it is going into gold, but part of it is going to multiple other jurisdictions. So if you look at South America, or if you look at Europe, if you look at Japan, if you look at China, a lot of those jurisdictions have done phenomenally well. Anywhere between 30-35% kind of returns, whereas India has significantly underperformed from that perspective. But can I go 100% on that? I would advise no. But a small allocation to that also really helps. So
What would be the ideal in your portfolio, about 25-30% global allocation?
it will depend upon your risk appetite.
Your risk.
Yes, because so when we advise clients, there are two, three things that we do. One is obviously there are model portfolios that we have. So we bucket you basis our discussion. Say, okay, you're a conservative investor, or you're a moderate, or you're a very aggressive investor, and we have certain models where we suggest that models. That's one way of doing it. The other way of doing it is there are clients who are in between. I am not a conservative investor, but I'm not a moderate investor. I'm somewhere in the middle. Or I'm not a very aggressive investor, but I'm not also a moderate investor. I want to be somewhere in the middle. I keep swinging. When the markets are down, I become very aggressive, but I also start getting restless when market returns are very high, and then I want to get back and become more conservative. So depending upon that, probably you would be somebody, I would say, as an active investor. You're constantly looking for opportunity, constantly trying to rebalance your portfolio to ensure that you are allocated to the asset class which is probably performing the best at that point of time. And there are two risks to it. One is if your view or your thesis works out, probably you will do phenomenally well in your allocation and your returns will be very good. But if your thesis doesn't work out, some parts of those allocations will significantly underperform. It's like taking cash calls in your portfolio. It's a double-edged sword. It can protect your downside, but it can create underperformance when the markets is doing the reverse. So this is again another slide which basically tries to tell you asset class rank across equity, debt and gold, and you will realize here that in the current year, gold is number 1, debt is number 2, and equity is actually number 3 in terms of ranking. If you see the last entry, gold has significantly outperformed, whereas equity has done even poorer than debt in terms of overall returns. But 1 year up, and you will see equity is in the second place. 2023, you will realize equity was number 1, gold was number 2, debt was number 3. This leadership keeps changing almost every year, and very rarely you will see. I think 2018 and 2019 was probably one of those years when the leadership did not change. Both gold, debt and equity remained in the same order for 2 consecutive years. But otherwise, if you see generally, you will see that the leaderships keep changing. Every few years there is another asset class which performs. So if you want to create an asset class or a portfolio which is resilient, if I am making my allocation at the beginning of the year and staying with it through, these fluctuations will not impact the portfolios too much. One asset class will give me, say for example, if I was invested one third in equity, debt and gold, you saw that gold gave me 50% return, so I would have made 17% on my portfolio on that. Equity and debt gave me something like 7 odd %. So net I would have made about 20% in my portfolio. But the year before, again gold gave me about 20% or 22% kind of returns, whereas other asset classes gave me very similar. I would have still come somewhere closer to that allocation. So if I am within my range of 13-14%, if that's my expectation, and as long as my allocation is set my portfolio is fairly resilient, it's not getting impacted by economic impacts, political impacts or anything. And I would also suggest that these allocations should not be fixed, it should also be a little moving, because with time the asset class performance also changes. For example, the view about gold has significantly changed over the last 1.5, 2 years. Today it has become a strategic allocation as compared to a tactical allocation. People are actually allocating 15-20% of their assets into gold. But 2 years before, that was not the case. It was more a tactical allocation. People only used to talk about two clear asset classes, equity and debt. Now you have the third asset class which has come in. And the fourth point of discussion is silver now. 2 years back, there were hardly any silver ETF. Some of them were 30 crores and 50 crores in terms of AUM. Today there is a mad rush to allocate, and people only look at past performances, 70% return in 1 year, phenomenal, let me jump in. But if you look at the silver history, when it corrects like, massive corrections. If you look at the last time silver hit a $50 figure, it was in 1980s. So since 1980 to 2025, it has taken almost 45 years for silver to go back to that level of all-time high. And it corrected, came down almost 15-20%. It's now gone up again to that, somewhere closer to that level. So it's very volatile. Can you make it part of your portfolio? Yes, definitely. It's an allocation. But can it be 30, 40, 50% of the portfolio? Probably no. But I can make a 10% allocation definitely to that. But should I only go to silver and not gold? And that's again another discussion we need to do. Are you an aggressive investor? Probably. If you are, then you can get to choose. Because there are periods when gold does well but silver doesn't do well. And then there are phases where silver does well and gold doesn't do well. So if you are allocated to both the asset classes, one of them will definitely do well, and there are cases when both of them have done well. So this is a very critical point of discussion, or point of I would say introspection that every one of us have to do. What is the kind of allocation that we need to do? This is another very interesting slide which I came across, and again this very clearly says no single asset classes outperforms consistently. You look at gold between 2017 to 2020, Jan 2017 to March 2020. Equity gave a CAGR of 0. So in a good almost 3.5 years of allocation, you hardly made anything in equities. Now a lot of investors will get disheartened, newer investors will get significantly disheartened, seeing this asset class is making no sense, and let me exit. Let me go to fixed deposit. I understand that, I make my 7%, I'm very happy. But you look at debt between Jan 2021 and 2022. If you are a mutual fund investor, you made 3% CAGR. Probably, maybe a couple of percent here or there, depending upon how dynamically those funds have been made, but you hardly made any return. Similarly, gold, for probably almost 6 years from 2012 to December 2018, the CAGR was 0. The same gold today is making 20, 30, 50% return, and we are going crazy about allocations. But that same asset class for almost 6-year period gave you nil return. But you take a period from 2000 to 2025, a 25-year period, and you calculate the CAGR of gold in INR, you will see that the CAGR is about 13%, because that INR has also the USD depreciation benefit, but you will see about 13%. But do we have the discipline to do this is a good question. I have seen a lot of investors lose patience. 1 year, they can be patient, 2 years, then they can be patient, but then they say, I am losing out an opportunity. There is an opportunity cost for the allocation that I am doing. I am losing out, I want to move out into another asset class. Similarly, silver, probably from 2011 to 2023, a 12-year period. For 12 years, if I had invested anywhere in that period of time, at the end of 12 years, I made zero CAGR. And I'm saying CAGR, But today, in that 1 year, it has given you almost 70% return. So it can be that testing, it can be that painful when you do an allocation. And again, this is equity. When you look at, we generally feel that I do an SIP and probably it will take care of all the volatility. But when did you start the SIP and at what phase the market peaked is also very critical. If I start my SIP at a period of time when the markets are at a top, all the future allocations are happening in a downward market. So I have averaged, but I am still probably lower than what the market is. I am still negative. But I just need that one good year, when this allocation can, or this savings that I have created can then, do well. So if it is one of those years when it is 30% or 40% or 50%, and if I have accumulated with patience over the 3, 4, 5 year period, that one good year changes everything. Similarly, if I have added in a rising market over a period of time, that one bad year can pull down my return, and I can say, oh, this is not for me, this asset class is not working out, let me exit. Because 4 years of encouragement, every year the market went up, I was very excited, I kept adding on to my SIPs, and came to a scenario where a bulk or probably almost 100% of my allocation is going to equity, and there will be that one bad year which will wipe out almost 30, 40, 50% of your capital, and this is your accumulated capital over the last 5 years, 6 years, 7 years, and then you calculate your CAGR, it will be negative. But both scenarios are not right. Saying when you are allocating and you're creating these buckets of investments, you need to have that patience of weathering this. And if you have an asset allocation approach, and when you are allocating across multiple asset classes, there is another asset class which has done very well in that period of time. So if gold has underperformed, equity would have outperformed at that point of time, and they are balancing out each other. And then when you look at your portfolio return, it doesn't look so bad. Maybe my expectation was 12 when it has given me 9. It's not bad. Probably the next year I'll make it up. But if I was in only one single asset class, it has its own challenges. And you will see it here, even within different buckets. In the current financial year itself, when you look at the last line, large caps gave you about 9% return. Small caps have given you negative returns. Can I be only, if I was a flexi cap investor at this point of time, the fund manager would have reallocated the portfolio depending upon where he is seeing opportunities. But if I was an allocator to large, mid and small, and in my previous years small cap had done phenomenally well, I have not reallocated. I continue to believe that this is the segment to be in, and the next year it will underperform. Which is why I said it's very critical to one of the questions that the gentleman had asked. At every, probably a year is a good point of time. So every year you relook at your allocation and you say, okay, even within the asset classes, if equity was 50%, even within equity, how has the sub allocations behaved? If one of the allocation has significantly done better than my expectation, should I not reallocate it? Or if I find that another segment, say if small cap has significantly underperformed, can I not reallocate it within that? So my overall allocation probably will not change, but within that 50%, I am now moving from a large to a mid or a mid to a small or any of those. That is also very critical to ensure that my portfolio is very resilient. And you can pick up any one of those years, so the green ones are the one when it is positive. So say 2018, So 18 and 19 you will see large caps have done minor 2% and 12% kind of return, whereas mid caps were negative in one of the years and small cap was negative in both the years. But the year after, you will see 2020, small caps are the ones which did very well. So if I had reallocated in both of those years and my allocation was the same in the third year, or look at the best scenario is 2021. I mean, look at large cap was 26%, whereas the small cap would be 63%, 3 times the returns. So 100 rupee allocated to all the three, this 100 would have become 126, this 100 would have become 163. Can you imagine the kind of impact it is doing to your portfolio? But was I able to foresee this? Because my last 2 years experience would have colored my mind, and I would have said this is not the segment to be in. The other segment is doing very well. Large cap has been a consistent performer. ये सारा बेच देता हूँ. Let me get into large cap. Probably this will do very well. But that did well. 26% is by no means a bad performance, you know. But when you compare it with something which is 63 and you feel, oh my God, I should have not exited. I should have stayed put. But had my allocation been 33 across, my returns at the end of the third year would have been probably better than what I am expecting. Because one asset class is significantly underperformed in 2 years is significantly outperformed in the third. And this is within your asset class. This is within equity as a bucket. This is another interesting measure that we normally track regularly, which is called drawdowns. Basically what it does is, what was the highest point of a particular asset class within a year, and when it corrects, what is the lowest point. For example, if you look at current year, the large caps have corrected 10% from their highs to the current lows. You know, so you see the 52-week highs and 52-week low. So the difference between that is what we say is a drawdown. Whereas you see the small caps, it is 23%. You know, so that's a fairly steep drawdown. And some of the years it is as high as 70, 65, 78. This is a reflection in terms of rebalancing. You know, if I am regularly rebalancing my portfolio at the end of every year, some part of these gains I am able to protect. Something which has done phenomenally well probably will do a significant correction. I am just avoiding that scenario. I am not leaving it for a future scenario. You know, unpredictability is something that I want to avoid, and this is what we are trying to do. So just to summarize, I am saying no asset class, you know, outperforms consistently. The leadership keeps changing within asset classes. Diversification between low correlated and negatively correlated asset classes is very critical, and that is what happens when you do an asset allocation. And gold is playing a very crucial role. It has always played a crucial role. Just that earlier people, very few people used to allocate to gold as a category. It was mostly a tactical allocation, and today it has come into a strategic allocation. People have started noticing it a lot more, probably because of dollar depreciation and what is happening with the US monetary and fiscal scenarios, with the Trump tariff tantrums. You know, earlier it was all about globalization, now it is all about localization. So the entire way the global economy is working is changing. You know, the whole thought process is changing. Earlier it was always outsourcing. Trade was always meant to be procuring it from the cheapest manufacturer. If there are 5 countries, I will go and buy from the cheapest manufacturer of that, and I will sell to them what I manufacture cheapest as compared to them. So it was mutually whatever was more advantageous. Today it doesn't matter. Everybody wants, whether I am cheaper or not, I want it to be localized. So today probably China is very economical in rare earths, probably the best in terms of how it is positioned. But US wants to localize rare earths, knowing fully well that entire exercise can be an extremely expensive proposition. But they want it. Why? Because it's more national security. It is strategic security. I am not dependent on country A, B, C, because the moment I am, I have a leverage which I have given it to them. I don't want that leverage to go. We want to be an equal leverage. So some of those is obviously now, changing the way geopolitics is being viewed, changing the way global economics is working. And because of that, gold has become a very, very interesting commodity. And tax efficiency is critical. As I shared earlier, within asset classes also, it is important to understand how they are getting taxed. What is the longer term taxation, what is the shorter term taxation. So if I am a systematic withdrawal investor, I would be better off in an income plus arbitrage kind of a bucket, the fund of funds which income arbitrage, because 2 years of holding later, after 2 years, any systematic withdrawal is at a 12.5%. As compared to the same process I do with a debt fund and I end up paying 30%. Right? In terms of overall returns, maybe a 50 basis point or a 70 basis point kind of a difference between a proper debt fund and an income arbitrage, because 35% is arbitrage. To that extent, the income will be slightly lower. But I save 20% on my taxation. So for a regular withdrawal kind of a scenario, I would suggest that could be a very interesting allocation. But not many investors have done it, because that was a category which somewhere got lost between the budgets. One smart wealth management entity discovered it, and then it all needs one person to discover it, and then it can be copy pasted by everybody else, and today it's become the hottest commodity. But it makes a lot of sense from an investor's perspective. 20% tax arbitrage is by no means small. So that is also very interesting. Secondly, a lot of us may need short-term funds also, whether it is bridge financing for example, we had a client who wanted to buy a property, and he said, and there was a loan and everything was sanctioned, but there was one particular arrangement that they wanted to do: sell one property and buy another property, and then there is a loan component, because he didn't have, his eligibility was not such that he'll get a loan for the entire purchase. So he was dependent on the sale of one of the properties. The challenge with property sales is that when you want to sell it, it doesn't get sold. When you don't want to sell it, there are 20 people who will come and say, are you willing to sell? That's how properties normally work. So he was in the market to sell, but it was not happening. Obviously the expectation that he had and the quotes that he was getting was slightly below. So he didn't want to be a desperate seller. So what the investor did was went and sold a lot of the silver and gold ETF holdings that they had, because they had significantly run up, and he was sitting on a huge gain there, but ended up paying 30% taxes because it was all short term. In hindsight, what a client could have done is he could have taken a loan against security, because sometimes to convert a short term into a long term, it's a 2-3 month kind of a timeline. So if you have taken a loan against security on that portfolio, your need for buying that property would have been satisfied. You're paying a very small interest. Even if I'm paying 12% for a 3-month period, I'm paying something like 3%. But I've saved 20% taxes, because if I sell it after that 1 year completion, instead of paying a 30% tax, I'm paying only 12.5% tax. So at that point of time, I can sell my units and close out the loan. Now that's a very smart engineering or a smart way of doing it. But a lot of us don't do that. A lot of us saying, okay, I have my savings and my allocation is done phenomenally well. I can actually bridge this by selling my investments and do this. I'm very confident. I have sold it. I've bought my property. Now the tax part hits you. Imagine you had a 1 crore allocation and silver went up by 70%. It's like your assets became 1.7 crores. And you needed about 1.5 or 1.6 to bridge this. You sold off everything. You use that money to buy your property. Your transaction is done. You're very happy. Now, who will pay tax on that 70%? So that 70 lakhs pay 30% tax is a 21 lakh hit. You have to bring it again, but you already sold all your assets and used that entire money for that. Had you waited for the 3 months more, instead of paying 21 lakhs or 24 lakhs in taxes, you would have only paid about 7 lakhs. So 14 odd lakh is what you would have saved, and out of that you paid about 2-3 lakh or 2 lakh or whatever that is as interest. You would still have made a significant savings, and that's your own money, right? It's not that you're borrowing or anything, it's your own investment. So sometimes a little bit of calculation in terms of the timing of sale is also very, very critical. So two sets of investors, one came to us and we said, why don't you do this structuring? The other investor actually just went ahead and did that on them, and he came to us post facto. Obviously we couldn't do anything because already all of the sale and everything was done. So he ended up paying the taxes for it. So these are small little things which we can all do legally within our overall portfolios and allocations. But what we just need to do is think through. Even when we are doing reallocation, can I wait for 1 or 2 more months to do this reallocation, because that will save me 30% of tax. What is my view that in that 2 months is something significantly going to change in the asset class? If yes, then of course I should go ahead and do the action. But if no, then I can wait for that. Even if the market comes down by 10%, even if that particular asset class is correct by 10%, I still save 10% in taxes, because instead of 30 I am still paying only 12, and 10% I lost because of market volatility. I still saved another 10%, which is critical. So when we are building a resilient portfolio, a lot of these little things which we tend to ignore is something we need to be very, very careful, and we need to pay a lot of attention on. And this is something that we generally advise clients. If we know exactly what the need is, we can figure out a solution for them without significantly impacting their portfolios. This is another slide where we are just trying to highlight how the correlation is. If you look at correlation between equity, debt, gold and silver, if you had all the 4 of them, it's a fairly uncorrelated portfolio. The most correlated is probably silver and debt, which is about 0.1% to that extent. Otherwise, hardly any. Now, if you're building a portfolio across all of them, your portfolio will weather most of these storms. Political issues, geopolitical issues are actually beneficial to your portfolio, because gold will do well at that point of time, or silver probably will do well, and equity will underperform. And REITs will also do well at that point of time. And if interest rates continue to be as it is, REITs will continue to do well. So correlation among asset classes is also very, very critical when you're building your portfolio. This is again a larger asset class correlation, and you will again see that when you look at a nifty correlation with gold, silver, gold plus silver, USD. So this is USD INR primarily for the ma'am asked a question about international investing. So if you are doing an international investing, and my view is that rupee is depreciating at a steady pace over US dollar, then yes. But if my view is that over the next 3, 5, 7 years, USD will depreciate more than rupee, then probably gold is a better allocation for me. Instead of overseas diversification, probably gold will be a better diversification for me. So that is also critical to understand when I am trying to look at a different asset class or a different allocation which is out of the geography. Then how are the geopolitical, the economical scenarios there, and what is it, where in the global sphere of things is that country positioned? Are they attracting investments, or are they sending money out? And how is their geopolitics, how is their economy doing? It's also very critical when we do those allocations. It's not easy because those informations are not very easily available to all of us. Many of us track Bloomberg, many of us track Reuters, many of us do a lot of global reading. So it comes naturally. A lot of us don't get those kind of information. So either a mutual fund could be a good opportunity to allocate, or play that using gold and silver. because if USD depreciates, your real assets will do very well. So it's a proxy.
How will gold be impacted? I mean, USD depreciate. Gold prices would be.
Yeah. So if today, if you are a US citizen and you had your money in US dollar and gold is appreciated almost 40-50%, you've lost 50% of your value versus gold.
You know, for an Indian investor, if I have to invest, you were saying that instead of investing outside, you are predicting that USD will depreciate.
Yeah. So every time you see a scenario where US dollar depreciates, the real assets benefit. And real assets could be gold, silver, copper, commodities.
That will be compensated by the loss of.
Exactly. So one getting, if I was an allocator to say a US asset, which is not the real asset, and that depreciation can have a negative impact. For example, if today US decides that I need growth more, I don't care about inflation, it doesn't matter, I need to bring down my interest rate significantly, and they start cutting interest rates in a very significant way. What happens to the US economy? Inflation goes up, significantly goes up, because we've always seen when you start cutting interest rates to a point where it is very low, asset bubble starts forming. So they are already undergoing certain challenges with inflation. It goes up. If I am an allocator of asset, I'll have to start deciding whether US is the right place to allocate, because inflation is impacting my currency value. What is worth today at $100 tomorrow may be worth $97 or $96, and so on. Just like how inflation is impacting rupee, right? Over a period of time, the value of my currency is depreciating. The same is happening in US. The value of currency is depreciating. But what is appreciating there? Gold is appreciating versus that. So instead of allocating to US dollar asset, I am allocating to a gold asset. So I am actually beating that inflation.
So the USD depreciation
is actually benefiting.
Would be offset.
Offset
the gold
by, yeah.
Somewhat, but still will be net positive.
Gold will still be net positive, because net the allocation to gold is significantly going up across the board. The other day I was seeing one very interesting article which said that over the last 4 years, every year central banks have been buying 1,000 tons of gold, approximately, give or take that number. But in reality, it is much higher than that, because they are not reporting all of that buys to the IMF or other agencies. So, and they were showing China's figure. On an average, China themselves have been buying 1,000 tons of gold, but the reported number is in the range of 400-500 tons. So under-reporting by almost 50%, which means they don't want to tell the US that I am reallocating. I mean, they know, US knows that when you are allocating to gold and not to US dollar, you are moving away from US dollars, but you don't want to spook them, so you're doing privately. And one of the reasons why gold is so resilient and it's not correcting is because there are a lot of purchases happening which are not getting reported across the board. So to your point, yes, if I feel US dollar will continue to depreciate over a period of time, I would want to be in commodities, assets which will appreciate or at least retain its value. And by retaining its value, I am still creating an alpha, because the other currency is depreciating. Even if I don't gain, I still make money.
Can you just come back to the previous slide? Can you explain the 10-year standard deviation which you have? In case of silver for 24.70, is that?
It's the most volatile. So the higher the volatility, higher is your standard deviation. So if you look at some of the assets like crude oil, it's extremely volatile. There was time, if you remember a few years back, crude actually traded at zero. It crashed and there was no takers. In fact, there were tankers which were floating around and people were trying to figure out, should I just give it away free, because the cost of transportation itself is higher. And then we've also seen the other side when crude has gone to 140 kind of levels also. Today, obviously China is not growing to in how it used to grow earlier. So to that extent, global demand has been subdued. Plus, you have a lot of trade happening between China and Russia, especially on crude and gas, and they share a very large border. So they're saving significantly on transportation costs. and a lot of them don't get reported also because it's happening in their local currencies. Hence, you see subdued, crude prices. But if you see geopolitical issues continuing to ramp up in Middle East, or more and more sanctions are put on Russia and countries like India are forced to look at other buyers, then you will start seeing the prices going up because the sellers are limited. The largest sellers are a few countries, and then there are a lot of smaller pocket of sellers, and some of them are in South America, and they're all going through their own challenges. So US is trying to get them under their sphere of control. So it's a very different set of discussion there, and geopolitics can be quite messy, but that's one of the most volatile, and you see USD INR also on an average 4.5% kind of variation. So even something like silver and gold, look at the differentiation, almost double, so the volatility in silver is twice the volatility in gold. So when we are allocating to different asset classes over a longer period, and this is a 10-year standard deviation, so over a longer period of time also we see these implications. This is very interesting in terms of how uncorrelated assets can help you. So if you look at the tech bubble in 2000 to 2003, how much time do I have? 10 more minutes? I should, okay. So if you look at I'll just take say one bucket. If you look at the 2000 to 2003 bucket, debt and gold gave you 8%, equity underperformed by 14%, right? If you had allocated one third, portfolio probably would have not given you any return, but you would have sailed through with least impact. But if you had allocated to any one of those, say equity, which is what most of us tend to allocate, you would see a significant drawdown. And same is the case in the financial crisis or COVID, and vice versa. If you look at the next bull market run, if you were one of the equity investors, you would have done phenomenally well, But is that the right only allocation? Probably not. If you look at up and down, in those two periods of time, you see a huge variation. On some of those buckets, it could be 35-40%. In some of the buckets, it is 40% plus and 40 minus minus. So the range is significantly on one side or the other. So again, between asset classes, when you are allocating it, it's very critical that the allocation is maintained and the allocation is also rebalanced at regular intervals. We've covered gold, so I'll skip gold. So again, this is something that I've summarized, saying you should have a core, you should have a satellite. So one of the gentlemen was talking about, what percentage should you keep it as dry. So dry powders normally come into that tactical, opportunistic ideas. If you have and you see an opportunity, you can actually use that liquidity, else you miss out on that. And you should always have a rules-based approach. You should ensure that you don't have concentration and you don't chase past winners. Something which did very well last year may or may not do as well this year, and hence an allocation is very critical. If we go by past returns and allocate, we probably will be disappointed more often than not. And debt and gold are stabilizers in portfolios. Today we are allocating a portion of the debt into gold also for our clients, given that we see over the next 3, 4, 5 years gold continuing to do well and remaining fairly stable. We don't see too much of volatility. Even after it had gone up from something like 3,000 levels to 4,400 odd levels on dollar terms, the correction was only about $300-400. It's still stable at $4,000. And not really fluctuating much, it's there. So you will see more a time correction happening over a period of time. So given that it's now become strategic, it's now become more prevalent, a lot of allocation are happening, gold and debt should definitely be used as stabilizers in portfolios. So this is what we are suggesting. So if you have a growth orientation, look at equity, global equity, and smart beta. A lot of smart beta, momentum, or growth, or low wall. A lot of those kind of funds have come in. See if you can, if that is of interest to you, you can allocate it to some of them. If you want a stable bucket, then you look at target maturity funds, debt, to stabilize the portfolio. And you want protection, you look at REITs, silver, gold from a protection. And a combination of all three is extremely critical whenever you're building a resilient portfolio. This is, if you don't have that combination, probably either you will significantly underperform or you will do very well in a particular year. But your portfolio will keep having significant volatility. That's what I thought.
Do you have any statistical model for this?
You mean statistical model on this? Difficult to prepare a statistical model because we don't know which asset class will do well going forward. I can say with relative understanding that probably this year gold should do well, but something changes, gold may not do well. So it's very difficult to build a futuristic model, and hence our experience has always said that create a stable model, knowing fully well that 1 year one asset may not perform. For example, if in the beginning of the year, if you had allocated 20% to gold and silver and say 40% to debt and 40% to equity have not given you anything, say 5-6% return. Debt would have given you something like 5-6%. So 80% of your portfolio would have given you something like 7-8%. But at 20% of the portfolio would have given you phenomenal returns. Now take say 2 years back, had you kept on to the same allocation, probably gold and silver may not have given you 70% or 50% return. They would have given you 10% return. So that 20% would have only given you a 2% or a 3% kind of an overall alpha. But equities would have done very well. So that 30-40% that equity does would boost up your overall return. So the moment you have your allocation of 30-40 of whatever that number that you are comfortable with, 1 year's underperformance will not significantly impact your portfolio. Very rarely do you see that all asset classes are underperforming in any year. Very rarely, and very rarely nowadays we are seeing more often all asset classes are doing well. There are phases when all of them are doing well. Today equities are doing well globally, gold is doing well, silver is doing well, commodity is doing well, but you don't see many such scenarios. Indian equities are not doing well, unfortunately.
No, what I mean, suppose gold and silver is increasing, giving a better return. So should you have some statistical model so that you from the 30% you can increase to 40%?
Yeah, we do. So what we do is we do tactical.
So that we can predict from the trend.
So we do tactical reallocation. So in April when we advise clients to increase allocation to gold significantly, we were about 10-12%, we told them to go up till 30-35%. People went. In October we said cut down. Probably it has run up significantly, cut down because we see a pause now for some time. And people reallocated into equities. Now you probably stay stable for 3-4 months, 5 months, and then you go back into gold. So you can do that tactical reallocation. So when we suggest, depending upon the client's risk appetite, we can create 3 different models: a conservative, a balanced, or a moderate. And there will always be a margin of tactical allocation, which you can keep moving up or down. So if at that point of time silver looks good or gold looks good or equity looks good, you can go a little overweight on that asset class and take advantage of that uptick and then come back to your normal allocations. That definitely we do. But difficult to predict next 1 year, 2 year which asset class will do well. We try and avoid predictions. It's more a allocation which will help you to weather all of these volatility. It doesn't matter which, but tactical is something, as you very rightly said, we do suggest clients to keep a dry powder of 10% or so, which you keep moving into different asset classes. If we feel that equity is now probably at a rock bottom, probably next 6 months equities will do very well, which is also our house view, we say get into equities now. We felt gold is significantly overvalued, silver is significantly overvalued. We said cut down. You made significant returns. Please book some profits and wait it out. Probably the next 3-6 months you will not see much happening, but use that money to get into equities. So those tactical reallocation is something which you can definitely do, but within a broader analysis.
Global equity and smart beta, how does one invest?
Mutual funds.
MF.
Yeah.
Because
You have.
pure play of global equity is there.
Yes, you have. You have pure play funds which will only invest in China. You have funds which only invest in US.
They've stopped taking, right?
Some of them have, but you will always find somebody or the other. So, for example, there are a lot of fund of funds which invest in various jurisdictions. There are a lot of ETFs also which come in, or like a Nasdaq ETF. Many of those are available. Yeah, but my only advice to all of you is that when you are allocating to this, just do a little bit of research, because what happened with silver ETF can happen sometimes with these ETFs also. There was a time not too far away when the Nasdaq ETF had come in. The ETF value had gone up by almost 30% as compared to the value of underlying Nasdaq. And a lot of investors who came in at that point of time, and when Nasdaq corrected, that entire premium evaporated, and they also lost because the Nasdaq went down. So assuming if Nasdaq is 100, my ETF is trading at 130, because there is so much of demand for investing in ETF. But when Nasdaq corrected from 100 to 80, I came back from 130 to 80.
But generally they are passive funds, right? They
Yeah.
fall down so badly.
They do, because even passive funds have to generate. Whatever money you are going to give me, I have to buy that asset.
No, the fall would be so drastic. That's
If the ETFs trade at a premium, take the case of silver ETFs, right? The logic says that whatever money, the net sales which comes to me, I am going and buying silver to that equal proportion. What if there is no silver available? So I'm short of silver. So I have money which you have given me, but I don't have a silver. So my net asset value of my fund is not reflecting the value of the ETF. Now, because it is constantly under demand, FOMO gets generated, everybody gets in, more and more money is coming in, but I am not getting access to silver. So the premium value keeps increasing. So if I was an investor originally, it is actually a great time for me to sell, because somebody is coming and telling me, if you are holding 1 kg of silver, I am giving you 15% premium. That's what is happening. I would rather sell it, because I know it is not going to go up by 15%, so I will sell it. Now it came down by 15%, so people who came in at that point of time lost the 15% premium plus the 15% value.
So should you give you advice to buy a physical gold and silver?
The challenge with physical gold is that you end up paying GST, you end up having to store it somewhere, and then when you go and sell it, a lot of time there is certain wastages that they claim. Though if it is a 24 karat, there is zero wastage. Technically speaking, it is the purest form, but you will still get a lower cost. So you lose out on these 3-4% in that whole transaction. Rather be in ETF, you can allocate to the lowest cost ETF. And gold is a pretty, fairly well run ETF. In silver, unfortunately, nobody was predicting that kind of flow to come in. So your supply chain or the back end was not so well integrated. Silver, gold to that extent is, a very large ETF class. So I would recommend ETF probably is the best way of allocating. But there is no taxation difference. Technically speaking, today they have all equated. So whether it is physical gold or fund of fund or ETF, the same taxation.
Can you explain the risk of having digital gold and silver?
Okay, so there is this advisory from SEBI which says that digital gold as a category is not an approved logic. Now, what is digital gold? Technically speaking, I am a custodian. I have got 100 kgs of gold, and I have kept it in a locker, locked and safe. And now I have a digital receipt. I've digitized it into 1 gram units. all of you want to buy it from me and I'm selling it to you. Have you gone and checked whether I have got 100 kgs of silver in the locker? Who is certifying it? Nobody. The logic in digital is that either I sell it as a digital form and I get my cash back, or when I want to exchange it for gold, I can ask the entity from which I bought it saying, please take back your units and generate that number of gold. So if I am holding 15 grams of gold or 50 grams of gold in digital form, I will say I am paying the GST or whatever that is, please give me a 50 gram gold coin. If they do not have that gold saved somewhere, they will say, I am sorry, I do not have it right now. So that instrument or the way of selling is something that SEBI has not given any clear guidelines. That is exactly what is happening with an ETF. So you are buying units which are traded and you have an underlying. But there are clear guidelines on how you maintain and what you need to do and at what interval it will get audited, etc., etc. So why go for a digital gold? Buy ETF, it is very similar. Today there is no difference in the taxation. It is the same long term for more than 1 year, short term is 30 everywhere. So technically speaking, you are not getting an arbitrage by going into one or the other, it is the same. So might as well go into an established platform which has got such a large track record. You can see how the prices are performing and getting.
How could one diversify REIT portfolio? Because there are 3 or 4 quoted ones.
5 of them now.
Yeah. So besides that, if you really want, are there anything in the private thing domain? Like AIF or something like that?
You can do AIFs. There are certain funds which will replicate what a REIT is doing. For example, they will buy rent yielding portfolios and they will pay off the dividends as and when they are getting it, and whatever the capital appreciation is over a period of time, they will sell the property and then they will pay you back. So there are funds which do this. In my view, I feel REITs are a lot more efficient, primarily because it is liquid. In an AIF, it is illiquid, it is locked in. When you need to change or create liquidity, you can't do that, whereas a REIT gives you that opportunity. Now you have SM REITs also. So these are very specific REITs which is created with one property. So a REIT will have a universe of properties, and you will get geographical diversification, in tenant diversification, etc. In an SM REIT, you don't get all of that. You get only one property. So it could be one floor, it could be one single building. In that, you get slightly better yields in that, but you are taking a risk of one single property. So you have that also. But both of them, if I have to look at AIF, REITs or SM REITs, I would prefer REITs given that it is more liquid. Probably there are 5 and a few more in the pipeline which will come in. That's enough, I feel, in terms of allocation. We are not seeing that kind of allocation also happening into that. People who buy it, they don't sell, generally. You will see all HNIs who would have bought it 3, 4, 5 years back, they don't sell. So new units are only when the retail is trading or when the REIT itself is adding new properties. It's like an alarm or something.
Advisable to redeem the Sovereign bond after 5 years now?
I don't think you. I don't think.
8 years.
After
5 years, you don't attract second capital gain or something.
It's the government which is desperate to give you back the money. Because it's a naked short position at the central government level. When I told you as a government that here is a bond, the underlying is gold, and I will give you the return that gold gives you, but I don't have any gold anywhere. It is the same scenario like the digital gold thing. So I am giving you the performance of gold without having gold kept anywhere allocated. Or best case scenario would have been At redemption, I'll say, I'm sorry, I can't pay you money, but here is X amount of gold, which is equivalent to the value that you're holding, because it's sold in 50 gram units, right? Multiples of 50 gram. So I'll give you 150 gram gold coin at maturity, saying you invested at this price. Today 50 gram gold coin is this. Here is your 50 gram gold. I don't have the money to pay you back, but I had the gold, so I'm not losing out anything. Here I don't have the gold, so what do I have to do? I have to actually figure out, where can I get that liquidity? I have to borrow, and then I have to pay, and on top of it I have to pay you 2.5% interest also. So they are forcibly giving back the money. You have a choice not to take it. I would, if I was an investor, I will not take it. Why? Because I have a view, personally also as an organization also, we have a view that gold will do well over the next 3 years also. So if that is my view, what do I do with the money back? Either I take it back and then I reinvest it in something else, or I let it be 8 years later when I get back the money, there is no capital gain, nothing. So I am very happy to hold on.
But what will be the value after 8 years now? So you are getting the value.
Whatever is the value of gold at maturity.
That may be reduced.
It can be. It can be lower than what it is today, but the view is that it will not be. See, if okay, let me put it another way. If today whatever is the gold value, you're holding for 3 more years. If your view is that you will make at least 7-8% return, and gold will be say 24% up in that period of time, in 3 years time, then I will hold. I'm okay with that. That is equal to a debt return. If my view is that gold will not do anything in the 3 years period, it will probably correct or go much down, I might as well take the money and put it in some other asset class.
What are your views?
My view is I am positive on gold. I will not take back my money. I will hold on to it and penalize the government more. They have taken enough from me.
In one of the slides you have mentioned in REIT that volatility is moderate and income opportunity is high.
Yeah.
How that classification is made?
As a category, how REITs have 2 sources of returns. One is the regular dividend that they pay. And how are they paying the dividend is, they have tenanted properties, they are getting the rental income and they are paying that rent as dividends to you, net of all expenses. Every year there is an escalation clause. Just like if you own a property, you are charging a 5% or a 10% escalation, there is an escalation clause. So your income keeps going up over a period of time. Of course, what can impact is interest rates, etc. Because if the cost of borrowing goes up significantly, then my increase in rental income to that extent will get impacted by the cost of borrowing. Otherwise, I'll pay back that entire thing to you. The other way of gains, which I don't pay you back, but it is there reflected in the NAV, is capital appreciation. So as we were discussing initially, if my property is in a prime location and that is fully tenanted, rented out, there is no other opportunity to build something nearby. The value for that rental property will continue. So over a period of time, till that, or I would say, for example, let's take an example of say, let's say Gurgaon, okay, and I have a AAA rated phenomenal property which is a 10-storied building where all the best tenants, right, from Apple to Google to Facebook is all tenanted. And there are a lot of other buildings also in and around, but probably I am maintaining it at par with global standards. It's the best maintained building, and I don't foresee any of them vacating, right. 5 years, 6 years, 7 years later, I've made my 5% increment. If somebody wants to build something next to it, and first of all there is no land, they will not get access to a land. Then even if they demolish or buy some other building, demolish, build it, construct, etc., my value doesn't go down. My value actually increases because I will say, look at my property, it is as good as new, and I've got all of these tenants, that guy has to still go and tenant it out. So just like how residential pockets continue to retain its value, places like Juhu, Vilepale, a lot of them continue to retain its value even after 5, 7, 10, 15, 20 years. Everybody wants to have a piece of property there, but nobody is selling. You are not selling, ma'am is not selling, nobody is selling. You are happy with that, but I want to buy, so I keep offering you more and more. So that capital appreciation of that location, the land, is an intangible way of reflecting. So my NAV keeps going up, so my unit value goes up. So my unit value from 100 would have gone to 140, and I am paying you 5, 6, 7% dividend every year. When I sell, I will get that gain. So REITs work on both ways. It adds capital appreciation and it gives you regular dividends, and those dividend keeps increasing because there is an escalation clause. So most of them have a 5% kind of escalation clause every year. So it sometimes one shot 3 years later 15%, or it is 5% every year, but that keeps happening. So it's a great way of hedging against inflation, because if you are only in debt, you only make that 7% every year. You may be in a 10-year deposit, you only get that 7, but inflation is impacting your portfolio every year. That 7% value is getting eroded. Here in a REIT, you get that 7, next year you get 7 plus 5% more, the year after you get 7 plus 5% plus 5% more, so you are getting incremental. So to certain extent it is hedging against inflation. So it's a great allocation. Internationally it's a huge asset class. In India it's still not gained acceptance. The bulk of it is held by HNIs, small portion is held by retail.
When you say we saw the presentation, we want to build our own portfolio, is it the return expectation a starting point to build my portfolio, or my risk appetite and
your risk
diversification, and return is the end result of it?
Return is technically a byproduct, and I will say that if you start with risk and you say I want to be the least risky or a conservative investor, obviously then you will have to realign your return expectation to something which will, see, risk and return are commensurate, right? You take higher risk, you get higher return. You take lower risk, you get lower return. So the moment you are taking lower risk, then you are mentally ready to get a lower return. I can't have the other. I can't have the best return and the lowest risk possible. And if anybody can do this, great, but normally not possible.
So I'll just add to that question. I'll give you 3 age profiles, like 30 years, 40 years, and 50 years. You could just give some numbers with respect to what kind of allocation you go.
So for someone who's younger, as a 30-year, we would say much higher allocation to equities. So something like 70% kind of allocation to equity, maybe about 10% or 15% allocation to debt, and another 10-15% to gold, silver. Part of the equity allocation can actually be added to gold and silver also. It could be a 60% and a 20% kind of allocation also to between gold and silver. The moment you come to a 40, doesn't change too much, but maybe a 50% or a 55% kind of allocation to equity, and gold can still be about 10-15%, and debt can be slightly higher now, say about 15 to 20%. And the moment you are above 50, I would say at least 30-40% to debt, 10-15% to gold, and about 35-40% to equities. Should be an ideal allocation. But of course, there are investors who may want to take slightly higher risk. There are investors who may continue to earn income. So there are a lot of consultants, a lot of professionals who have a regular flow of income. So for them, this particular asset is not the income generating asset. It is probably an investment opportunity. So they can take probably a higher risk. And then there are people who are regularly dependent upon their allocation, they may want to take a lower risk.
Also, the security borrowing and lending scheme, what exactly is you lend it to money?
So
Is
they,
it like a PMS or something?
no. So there are, you lend it through this exchange. So there is an exchange mechanism. There is a specific section for lending and borrowing. So if I am in need of a stock, I will say I want X quantity of stock. So I will put my request. So it's more like your online trading. You allocate saying I'm willing to lend this quantum of my stock. So there may be hundreds of people who are willing to lend. All of that pools in and comes as a availability, and I borrow from there. So it's more a lending and borrowing mechanism, but it's now been automated. If you have significant allocation in equities, we can also help you do that through our app.
Sir, just one thing. Equity, for an investor, ordinary investor, there are learned people also, ordinary people also. There is a mutual fund available. You can even put it under PMS where people can guide you with the amount decidable. AI, you can put it. Even AI can help you out with, let's say, pre-IPOs or even for that matter, private equity. Commodity market is ignored, or is there any opportunity in commodity market like this? That's all.
Unfortunately, in India, there is no AI which is investing in commodities. And even if they do, they only invest in gold and silver. And the primary reason is that our derivative markets are not deep enough. Today, you would have heard about market linked debentures. Market linked debentures are actually nothing but a bond which has got a derivative component to derive the return. You don't have that in silver also, because the markets are very shallow. And you saw one example where small demand increase resulted in no supply available. So when you have scenarios like that, it is very difficult to structure anything. But internationally, you have a very, very deep and established futures market. Whether it is a Chicago Bourse or a London Business Metal Exchange. So offshore, if you want to take exposures on a commodity fund or something, you will get a lot of options. You will get palladium, you will get so you will get multiple options. You could get silver, copper, aluminium, crude. Lot of those options you can get through ETFs and all, because the derivative markets are very, very liquid. And even the asset market, because they deal in bulk, and a lot of global trade also goes in through these exchanges. It's fairly easy to create that kind of side. India, unfortunately, it's still not developed. We are still away. So only alternative at this point is silver and gold, or you could look at specific ETFs like a metal ETF or something, but the underlying is equity there. So they may buy a Hindustan Copper or a Vedanta and give you an exposure on copper or silver or zinc, but it is not the commodity, it is a commodity company, the mining company or the, so that's the only challenge. To some extent, you can still play that, but you will not get 100% commodity kind of.
I think we are on top of the hour.
Great. So thank you so much. It's been my pleasure. I hope I've been able to share some thoughts which hopefully will give you some guidance in terms of how you want to structure and create a resilient portfolio. And we are very happy to assist you one-on-one. Tejal is here. You can reach out to her, and we'll be very happy to work with you. Thank you so much. Thank you.
So I'd like to thank Mr. Rajkumar Subramaniam first, and the team from PL, Prabhudas Liladhar, for holding the session for us. Very simplified way of putting across how a portfolio should be structured. So thank you so much for that. Taking time out on a Sunday for us.